So, yeah, we're going to dive right into that question. What was Warren Buffett's single worst deal? Because finding the answer to that, well, it does a lot more than just tell us about a really, really bad day at the office for the Oracle of Omaha. It actually cracks open the secret to his biggest successes. So, today we are unpacking Warren Buffett's billion-dollar wins and his billion-dollar losses. We're going to go on a journey through the absolute masterstrokes that built his empire, and then we're going to look at the blunders that cost him dearly, all to figure out the timeless lessons that, honestly, any of us can learn from. Okay, so here's how we're going to break it down. We'll start with a real quick look at the legend himself. Then we'll get into those incredible billion-dollar wins. After that, we'll dissect the humbling blunders, pull together the core principles from all of it, and then wrap up with the key takeaways for you. All right, first up, the Oracle of Omaha. To really get the scale of his wins and his losses, you first have to appreciate the incredible amount of time he's been in the game. I mean, just look at this career. It stretches across generations. He bought his first stock in Geico way back in 1951, when he was just a student. In the 60s, he takes over this failing textile mill. You might have heard of it, Berkshire Hathaway. Then comes that legendary bet on Coca-Cola in '88. And just when you think you've got him pegged, he goes and shocks everybody by pouring money into Apple in 2016. And the result of this long, long marathon? A personal net worth of over $150 billion. He has seen it all. So, how did that marathon career lead to this pantheon of genius investments? Let's take a look at the wins, because these aren't just about picking the right stock ticker, they're about a whole philosophy, a way of seeing value where nobody else does. Okay, first up, the all-time classic, Coca-Cola. In 1988, Berkshire Hathaway started buying up a ton of its stock. And yeah, it's true, Buffett is a huge fan. He famously downs like 5 cans of Coke a day, but his investment had nothing to do with his sweet tooth. This quote, this is the whole game, right here. Buffett saw that Coke wasn't just selling fizzy sugar water. It owned a piece of real estate in your brain. That brand was a fortress, what he famously calls an enduring moat, that no competitor could ever really get across. That brand power, that's where the real value was. And the power of that moat is it's mind-blowing. An initial investment of $1.3 billion has swelled to almost $25 billion. And that doesn't even count the hundreds of millions in dividends that Berkshire gets paid like clockwork every single year. Next up, American Express. This is one of his forever stocks. See, back in the 1960s, the company was almost wiped out by something called the salad oil swindle. It's a crazy story, but basically a client defaulted on huge loans that were secured by salad oil that didn't exist. Wall Street completely freaked out and the stock got hammered. But Buffett, he did something different. He actually went out to restaurants and stores, talked to people, and he saw that they were still using their Amex cards and traveler's checks. The brand itself was totally fine. He bought a ton of it then, and he bought more in the 90s, building up a stake that today is over 21% of the entire company. So while everyone else was reading scary headlines, he saw a fantastic business with a powerful brand moat that was just temporarily on sale. And now for the big one, the one nobody saw coming. For decades, Buffett famously stayed away from tech stocks. He'd always say, "I just don't understand them." Then, in 2016, he starts buying Apple. And not just a little, billions and billions of dollars worth. So why the huge change of heart? Well, he realized he wasn't looking at a tech company at all. He saw it as a consumer products company with the fiercest brand loyalty on the entire planet. He eventually called it probably the best business I know in the world. He didn't see the iPhone as just a gadget. He saw it as an essential part of your life, a piece of indispensable real estate that lives right in your pocket. It's still Berkshire's single biggest investment by a mile. Now, with a track record like that, you'd think the guy is infallible, right? But this is where the story gets really interesting. Buffett would be the first one to tell you this. You don't need to be perfect. You just need to win a decent amount more than you lose. So, let's talk about the losses. And that brings us to the humbling blunders. This right here is where the best lessons are. Because Buffett is incredibly open about his mistakes. He doesn't try to sweep them under the rug. He uses them to teach. Dexter Shoe Company. In 1993, Buffett bought this shoemaker from Maine. He thought it was a great business with a long, profitable track record. In fact, he liked it so much, he didn't even pay with cash. He paid with Berkshire Hathaway's stock.
And that was a catastrophic mistake. Because in his own words, the durable competitive advantage he thought Dexter had, it just, poof, vanished. Cheaper shoes from foreign factories completely wiped out their business, and paying with Berkshire stock made the mistake 1,000 times worse, turning the true cost into billions and billions of dollars in lost potential.
So the Dexter disaster is like the perfect anti-example. It shows you exactly what happens when that moat dries up. A competitive moat is what protects a company's profits, right? Coca-Cola's brand is a deep, wide moat. Dexter's shoes' reputation for being made in America was a moat, until it just wasn't strong enough to stop the flood of cheaper global competition. Another famous blunder, his on-again, off-again relationship with the entire airline industry. He bought US Air in 1989 and hated it almost immediately, calling the industry a death trap for investors. He got out with a profit, but you'd think he learned his lesson. Well, not quite. In 2016, he jumped back in, investing billions in the 4 major US airlines, only to dump the entire position at a huge loss when the 2020 pandemic hit, admitting the world had fundamentally changed. But the biggest irony, the ultimate blunder of them all, was the very company that made him famous. He called the original Berkshire Hathaway textile mill the dumbest stock I ever bought. He bought control of the company out of pure spite in the 1960s because the manager tried to cheat him on a deal. It was a terrible business in a dying industry that just burned cash for 20 years. He estimates that single emotional decision cost him something like $200 billion in lost opportunity. Okay, so let's put this all together. When you line up these massive wins right next to the catastrophic losses, a really clear set of principles starts to emerge. This is where we connect all the dots. This chart just lays it all out perfectly. Look at the winning investments. Coke, Amex, they all had these super durable, powerful moats, usually a world-class brand. Their business models, simple, predictable. And why did he buy them? Cool, rational business analysis. Now look at the losers. Dexter, the airlines. Their moats either disappeared or, in the case of airlines, were never really there to begin with. Their businesses were complex, capital-intensive, and cyclical. And the reason for buying? A miscalculation of the moat, or in the case of the original Berkshire, just pure raw emotion. So what does all this mean for us? Let's bring it all home with the key takeaways. Because the whole point of studying Buffett isn't to try and copy his exact moves, it's to absorb his way of thinking. So here are the 5 big rules. First, only invest in what you actually understand. Stay in your circle of competence. Second, demand that durable competitive moat. Ask yourself, does this company have a real, lasting advantage? Third, remember that price is what you pay, but value is what you get. A great company is a terrible investment if you pay too much for it. Fourth, and this is a big one, avoid emotional decisions. As we saw with Berkshire, anger is a horrible financial advisor. And finally, think for the long term. All of his greatest wins took decades to play out, not just a few months. So we'll leave you with this question to think about. If the Oracle of Omaha's biggest mistake, a $200 billion blunder, was driven by emotion, what's the biggest emotional barrier that's holding back your own financial decisions? Is it fear, greed, or maybe, just like a young Warren Buffett, is it a little bit of spite? Something to think about.